Hello and welcome to the Monday Futures Market Outlook for April 30th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the US dollar and we take a look how it's trading against a basket of currencies using that dollar index futures contract. And we can see that the dollar has weakened over the last week and has broken this sort of triangle formation that we've been sort of identifying. That doesn't necessarily mean a new downtrend has begun. There's some substantial support lines right here below that could create a bounce off of those support lines. A lot of that strength is coming from the British pound and as well as some of the commodity-based currencies like the Canadian. But we still have yet to see the euro make a substantial move, and we'll talk about that in a moment on a chart. Overall, we remain in a relatively tight 2-point range on the US dollar over the last 4 months, and at this stage there is no indication of a new trend starting underway. We take a look at that euro futures contract. We drew a little rising wedge formation here. As you can see, that even though we've put in some sort of a short-term bottom at that 130 level and the market simply wasn't willing to break it, the same regard, the euro bulls have substantially failed to show any upside follow through to kind of indicate that the euro is actually going to go higher. In fact, after 2 weeks of rallying, we have yet to see anything that substantially looks impressive in any way. We remain relatively suspicious that this euro could break down, and with the euro being one of the major input variables against the US dollar, therefore we have to remain relatively neutral on the US dollar as it approaches those previous support lines. It would take a substantial rally above 134 on the upside for us to kind of abandon this kind of a perspective on the euro. Next year, I want to take a look at the 30-year Treasury bonds and whether we're talking the 10 years, which have actually reached all the way to their previous highs. The 30-year Treasury bonds have done a phenomenal job recovering off of the lows that they put in back in March. It's very interesting to see the fact that treasuries remain relatively strong in spite of the big rebound in stocks. And this is sort of, at least from the trends that we've seen in the last decade, this is something that is not a normal process. In fact, in many cases, bonds have been used as a risk-off trade, which means that money would flood in there when people were concerned about the markets. And really here we have a scenario where the markets are not that far from their highs at the same time as the 30-year Treasury bond are near their highs, and one of the two is going to give more than likely, and they'll start moving inversely at some point. And so it's nonetheless interesting that in spite of the S&P 500, which we'll look at here shortly, having that strength, the bonds are certainly not worried about it. Next year, I want to take a look at the copper futures, and we can see copper has substantially strengthened back to the middle of its range. We were looking for that breakdown in copper to stick, but that 360, 365 support line right now has held. Really, at this stage, we just simply believe that it's going to be hard for copper to substantially exceed its previous highs. So we're in a situation where we've had a rally back up to the top in the range, but we see still some substantial overhead resistance that should make it difficult for copper to make any progress much higher than these levels right here. Next year, when we take a look at crude oil, unlike a chart like on copper, crude oil has actually not been able to follow through on the upside at all. This is interesting because even if you go back to the last year of price action, there's been a lot of nice trends that come off of these kind of consolidations, and there simply has been very little to almost no interest to rally crude oil any higher. This creates this kind of almost wedging formation the way we're seeing on the euro, and we want to see whether or not crude oil here can follow through. Like we were suggesting over the last month, is that if crude oil breaks below that 101, 103 level, we would consider a number of more bearish scenarios, but we still want to remain optimistic that crude oil could actually bullishly follow through out of this wedge, and at least at minimum retest its previous highs. So we're watching carefully here to see whether or not crude oil can actually muster up a rally here or not, or whether this actually leads to a breakdown. Next year, I want to take a look at gold futures, and gold continues to really be making lower highs and along the way. But overall, we've been sort of anticipating this wedging formation. We were suggesting all along that the 1630, 1640 level was going to play an important role in determining whether or not gold was going to be able to rebound back to 1700 or 1750 on the upside. And really at this stage, you can see where gold has attempted to break out and is already slightly off of there and only about $8 away from that support line. This is going to be an interesting place to watch gold, because gold really needs to have some sort of bullish follow through on the last few days of price action, and really kind of kickstart a move higher, particularly trying to beat that 1680 level on the upside to kind of really open that window. If again, where we want to remain optimistic that gold could make that break on the upside, but if we see any breakdown below that 1630 to 1640 area, that would certainly open the window for a very fast downdraft to retest the lows at 1540 to 1560. So let's watch how that develops. That brings us to wanting to look at the S&P 500. As always, we start off with the weekly chart going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles we've gone through. Right now, the trend line remains pointing higher. The moving average line is pointing higher while we remain above it, which continues to indicate that we're in a bullish phase within this market, and we're simply in the bigger picture looking for a consolidation, probably back down to those moving averages. But we're not going to become big picture bearish on this market unless there's some substantial price action damage below that 1280 level. That brings us to looking at the S&P 500 on the daily charts, and we were very close to actually completing the pattern that we were looking for. We were looking for a few days of selling that would come down towards this 1340, 1320 area on the downside before the buying opportunity, but Apple Computer's earnings really kind of it plays the role of the general in the market, really reversed the market without finishing that reversal pattern on the downside. That really is hard to justify as being a correction. It never really even retraced to even retest some of those previous low swings. Now, there certainly is room for this market to now come back and retest some different higher points, but really at this stage we don't think that it was enough of a correction to justify taking a new bullish signal. You can see that with the bond market still near their highs, there's a lot of skepticism. Not only that, but we are now officially in the sell in May and go away cycle, where traditionally a lot of investors will exit the market as the weak markets in the summer tend to be a difficult time to make money within the stock markets. Really at this stage, because of the shallowness of that sell-off and the fact that it had this little reversal, it is more than likely that this rally here is going to be a part of a topping formation, which means that somewhere in the zone, this 1400 level is roughly where the 78.6 retracement lays. So that's sort of a key top retest. We could have double tops. We can even have a rally up to even 1550 that can potentially create a head and shoulders formation. But really, because of the lack of selling that we saw during that sell-off, we believe that in the bigger picture, while there is room for this market to now again advance up higher, the risk-reward proposition of being long the market from this level is not remotely as good as if we had the opportunity to buy it down at 1320. So really at this stage, we are open to the idea that this market will come back up to those highs or to somewhere within this zone, but overall we do believe it will be a topping formation, and we don't feel that we should be rushing to be buying this market, particularly when this is happening at the same time as we're at a seasonal high. when we look at our key intermarket observations, we were looking to potentially even turn bullish on the U.S. dollar if it turned up positively. But really, at this stage, we again remain short-term neutral. The dollar is simply not indicating a bullish short-term trend, and so but we don't feel that it's a bearish chart pattern either. And so the neutral stance is something that we'll remain on. In the same regards, when we basket commodities as a whole, everything from things like wheat are still within its range. Gold is sort of in the middle of that range. We have crude oil being non-committal, as well as no follow through on the downside on things like copper. You can see that it's very hard for us to take either a bullish or a bearish stance. We don't feel it's a bullish commodity market, but there's certainly no bearish indications for a short-term trend. We remain long-term bearish commodities. We believe that there will be a further weakness in the commodity markets in the long term, but there's certainly no short-term indication of that. In the same regard, bonds are the closest to being short-term bullish. The problem here is that we simply don't, with the overhead resistance levels where they are, we certainly don't want to turn bullish on the short term right as we bounce off of a overhead resistance level. So again, we remain very much neutral, the same way we've been for the last month and a half or so. Stocks could have been at some point bearish. But really at this stage, again, we don't necessarily believe we're on the verge of a new bear market. So we can't be long-term bearish the stock market. But in the same regard, at some point, if stocks rally up to, let's say, 1420, 1450, and are failing at those levels, we might actually turn short-term bearish based upon the seasonality and potential topping formations that might start developing into the first few months of this May-June cycle. That was your Monday Futures Market Outlook. Thank you for joining me.